In the month of October, again, we saw a lot of green. Now, this wasn't uh, this wasn't without some chaos. So we had some regional banks report on some possible fraudulent loans, and some of them are really having a tough time right now. You have Jamie Dimon, who's the CEO of JP Morgan Chase, saying, "Oh, there's never one cockroach." So meaning, there might be more fraudulent loans, there might be more chaos within the system, but the market really shrugged all that off. Now, again, for the month of October, most of the stuff still continued up. Now crypto's hit, being primarily Bitcoin, Ethereum, Solana, has hit a bit of a standstill, a bit of a flat line. Even some of it going down into the month of November, some of it going fairly significantly down. Um, but as a whole, everything if we look at basically this whole year, everything has pretty much worked from regular stocks to precious metals, especially crypto, global stocks as well. Global stocks remain very high, and happen to be if we have to sell for any particular reasons, those are primarily where we're looking at right now, because we have seen a substantial increase this year. But uh, the main thing that we want to say this year, or this month rather, is there are signs of frothiness. We've seen a significant, rebound certainly since April, but overall growth across this year, coming off of two other, fairly substantial growth years. And when that happens, people start to get more speculative. There's more money in the system, so there's more in treasuries, more in money markets than there has been in the past. And so as people look to, put more of that to work, whether it's from their earnings or whether they're, as Fed interest rates go down, people start to say, okay, now I'm ready to put more money to work. Well, they can, and sometimes they do get more speculative with that. And so that's our note. That's something we're really looking at. Um, it's still not overly significant, like say 2021, where we had SPACs, coming out almost every single day. We had IPOs, we had all these different, financial matters, and we saw a significant crash right after. But um, some signs start to be there. For a year plus now, people have been talking about a bubble related to AI, and to a degree, there is a substantial amount of risk related to AI, primarily because not only are the tech companies, which are primarily associated with AI, are they significantly growing from a stock standpoint, but their capex spend only seems to be increasing, at least from what they're saying. But in that capex, it's building out more infrastructure so that they can have more compute. So if they're building more infrastructure, your construction companies, your industrials, your utilities, your energy-related stocks are all seeing a significant jump. So that's where so the best performing sector this year has actually been utilities, which almost very rarely happens. But it's because we need so much energy, because we need so much compute, because people truly believe in AI that much. And that's where, we do believe at some point there will be some sort of drop. There is a narrative out there. There is a story out there where maybe there is enough growth to be seen. Maybe enough people can see the benefit of AI um, and its short-term impact, not just its long-term, that we're able to remain steady. But more likely than not, there will be some aspect of sell-off. Now, um, this firm doesn't necessarily believe that's going to happen before year end, which of course it could. But even going into next year, what we're kind of predicting is that at the top of the year, you're probably going to be some selling off, because again, there's been significant gains, and in that, especially early January time, if you were holding one of these utility stocks that really doesn't, rarely sees growth, well, you're probably going to sell some of that in order to take your gains. So we'll probably see some selling off there. Maybe you see some selling off come tax time because people owe taxes on the gains from selling off stock. But there are other reasons to think um, there's still room to run. And we don't, again, with what we're doing and being long-term investors, we primarily maintain our positions. However, as we've mentioned in the past couple of months, we are looking at a time to possibly rebalance because some of our primarily single stock holdings, or there are going to be some pockets of our overall portfolio that have appreciated more than others, and we are looking for when to kind of hit that rebalance. Now, again, probably not going to be this year, and certainly when you look at a retirement account versus a taxable investment account, you're going to have different stipulations in there. But that's what's at the forefront of our mind. We think there's still room to run. We're not going to quite take our gains just yet. But as I've said again in prior months, if you have any concern in there, make sure you're reaching out to us. Make sure you're having a conversation with us, and make sure that we are pinpointing a decision that is specific to you, not just an overall broad client base. Thank you guys so much for watching this, and I will see you in November.